Welcome to my tutorial. Please like this video and subscribe to our channel.
Imagine building a portfolio that pays you a steady stream of cash every single month without ever having to sell your shares. You just buy them, hold them, and let the income roll in while your account stays intact. The traditional way people do this is by buying dividend stocks. You purchase shares in massive, established companies, think Coca-Cola or Walmart, and in exchange, they share a slice of their quarterly profits with you as a thank you for being a co-owner. It sounds like the perfect plan, until you look at the actual math. For the most part, these traditional dividend payments are small, usually averaging around 2 to 3% a year. On a $10,000 investment, that's barely enough to cover a few cups of coffee a month. This chart shows the interest rate on government bonds. For decades, this was the gold standard for safe income, the money you could earn without any stock market risk at all. In the 80s, that yield was so high you could practically retire on it. But as that line plunges toward zero, that safe source of cash dries up, forcing everyone to look for income in the stock market, where those tiny 2% dividends just aren't cutting it anymore. While traditional dividend stocks are safe and reliable, they are simply too slow for someone who needs serious, consistent monthly cash flow to help pay their bills right now. To understand how some investors get around this, let's step away from the stock market for a second and look at a house. Imagine you own a home worth $300,000 and you own it outright. One day, a developer approaches you with a deal. They offer to hand you $2,000 in cash today, just for the right to buy your house for $320,000 at any point in the next year. You get to keep that cash no matter what. If the market stays flat and the house is still only worth $300,000, the developer isn't going to exercise their right to buy it for more. The contract expires unused. You keep your house and you keep that $2,000 in cash. But what if the neighborhood suddenly becomes the next big thing and your house's value shoots up to $400,000? Because you signed that contract, you are legally forced to sell it for the agreed upon $320,000. You miss out on $80,000 of potential profit. This is the core trade-off. You are willingly giving up the possibility of a massive lottery win in the future in exchange for the certainty of getting a check in your hand today. This exact strategy exists in the stock market. In the industry, it's called writing a covered call, which is just a fancy way of saying you are the one creating and selling that deal to someone else. Selling these contracts one by one is a lot of work. But a covered call ETF automates the entire process for you. It handles all the complex paperwork and trading in the background. Here is how the fund works. The ETF buys a basket of top-tier stocks, like Apple or Amazon. Then it systematically sells those right-to-buy contracts to other investors, over and over again, every single month. By continuously selling those rights, the fund collects a massive amount of cash.
The result is that these funds often generate yields of 8 to 15% a year, and that money is deposited directly into your account as monthly income. Instead of waiting for a company to share its quarterly profits, covered call ETFs effectively manufacture their own high-yield income by selling the growth potential of their stocks to someone else. But there is a catch. The stock market moves much faster than real estate, and capping your upside comes at a very real, measurable cost. If you compare a standard growth fund against a covered call fund during a strong market, the difference is clear. While the standard fund soars, the covered call fund repeatedly hits a ceiling. It's making money, but it's not truly growing. If your fund pays you 12% in income, but the stocks it owns grow by 20%, you permanently miss out on that extra 8%. Over a decade, that gap in your total wealth becomes enormous. It can also be painful when the market drops. If stocks crash, the covered call fund takes the full fall alongside everyone else. But when the market bounces back, the fund's recovery is immediately capped by the deals it sold. It goes down fast, but it can only come back up slowly. That is the trade-off. To get that high guaranteed cash today, you are sacrificing your portfolio's ability to snowball and grow during the best economic times. You don't always have to accept a rigid, robotic cap on your growth, though. Some funds take a more flexible approach through active management. Traditional covered call funds sell contracts at the exact same level every month, no matter what. But in an actively managed fund, human experts make strategic choices based on what the market is actually doing. These managers can adapt. In a booming market, they might sell fewer deals to let the fund's value rise. In a flat market where nothing is moving, they sell more to keep the cash flow heavy. This flexibility means these active funds often do a better job of protecting your initial investment during wild market swings. The trade-off is that because they are being more careful, they usually pay a slightly lower monthly yield as a result. Even in this world of high income, you have to choose your priority. Do you want the absolute maximum amount of cash possible right now, or a more balanced approach that tries to keep your original savings safe? Ultimately, deciding whether to use one of these funds comes down to your personal timeline and your ultimate goals. If you are a younger investor with decades of work ahead of you, a standard growth fund is likely the better path. You have the time to let your wealth grow as large as possible. But if you are retired or you're someone who needs predictable monthly cash flow right now to pay for your lifestyle, these funds offer a unique way to turn the stock market into a paycheck. Just keep the taxman in mind. Holding these in a standard account can lead to a surprise at tax time because the IRS treats this options income differently than the dividends you might be used to. You don't need to be a professional trader to generate double-digit monthly cash flow. You just have to be comfortable trading tomorrow's potential growth for the absolute certainty of cash in your hand today.